Good morning and welcome to Inside India. I'm Dan Murphy in Abu Dhabi today. Here are your headlines. First, Russia expects India to keep buying its oil despite US pressure. Moscow suggesting it could even start supplying Russian LNG to the South Asian country. Plus, India's state refiners said to be back in the market, buying Russian oil as discounts widen. And Indian banking tycoon Uday Kotak in an FT interview calling on the government to do more for small and medium-sized businesses in the face of Trump's tariffs. Good Thursday morning. Welcome to the program. Great to have your company over the next hour as we unpack what is happening across the markets here. First, a live look at how Asia is trading right here, right now. And with regards to the direction of travel today, well, you can see it's a broadly mixed picture overall. As it stands, markets in Australia currently leading regional equity gains, better by more than 1%. The Kospi also 1.13% stronger, but Japan's Nikkei 225 has been pulling lower through the course of the session, down by around 0.6%. The Indian market's also coming online in about 45 minutes' time. Here's what Nifty futures are currently indicating right here, right now as well. And as we track into the open, you can see a broadly positive start expected when trading gets back underway. Interestingly, a Reuters report highlighting today that foreign investors have sold more than net $13 billion worth of Indian stocks this year. That includes around $2.4 billion in the first half of August alone. And the Sensex also still trading at around 23 times forward earnings. That is amongst the highest in the world. So we're going to unpack how to trade it later on this hour. In other news, Russia says it will keep supplying oil to India despite fresh warnings from Washington. Russian officials in New Delhi insist the flows will continue despite President Trump's tariff threats on India in retaliation for buying oil from Moscow. Officials stress the discounts make crude too profitable for India to give up, with hopes to also start exporting LNG to the South Asian country too. All of this as Moscow pushes for a trilateral meeting with India and China, hoping to forge what it calls a greater Eurasian partnership. Meantime, India's Foreign Minister S. Jaishankar is in Moscow, where he will meet his Russian counterpart today. Ahead of that meeting, Jaishankar raising concerns over tariffs and non-tariff barriers. He also called for an early completion of new trade deals with Eurasian nations. Indian refiner Nayara Energy, backed by Russia and now under EU sanctions, is turning to a dark fleet to keep oil and fuel moving. Crude flow and shipping data shows the company has imported at least 7 cargoes of Russian Urals this month, including on sanctions-hit vessels like Centurion and Mars 6. Nayara, which runs about 8% of India's refining capacity, has been forced to cut operations and is now seeking government help to secure ships. Russian entities are now stepping in to help the company arrange tankers, even as insurance and shipping firms pull back. There's been no comment from Nayara. Meantime, steep discounts luring back some Indian refiners to Russian oil. Reuters reporting today that state-run Indian Oil and Bharat Petroleum have bought Russian oil for September and October delivery. They had paused purchases in July after Washington's criticism and President Trump's threat of new tariffs. But with discounts on Russian Urals crude now widening to about $3 a barrel, officials say it's still too attractive to ignore. The return of India's state refiners to the market could mean fewer supplies for China, which had stepped up buying during their absence as well. A quick check on the oil markets for you right here, right now as well. And of course, oil has been relatively volatile through the course of this week, really influenced by not just the geopolitics, but also the data in the United States. Right now, WTI 62.96, better by 0.4%, and Brent holding on to that 75 USD handle, also up by around 0.3. So let's unpack all of this with Probal Sen, a senior research analyst at ICICI Securities, joining us live now. Probal, great to have you on the program. Welcome to Inside India. First, we have to begin with the geopolitics currently playing out in the crude patch. You really have to think here. Russia still expects India to keep buying its oil, but is a $3 discount on Urals really worth the geopolitical pushback that we see on India right now?
Honestly, I think I would sort of leave it to the ministry and the government's official stance, which has basically been that, they would continue to purchase energy from whichever source it's available at the most optimum price. and they would continue to sort of source energy given the kind of requirements that we have from all the sources that are available. If you look at the commentary that the oil marketing companies actually made in Q1 results, they were very clear that the reduction in Russian crude percentage compared to earlier periods was in part driven by the fact that discounts had actually come down to somewhere around $1.50 a barrel. So as you were mentioning in the news item that has appeared, if the discounts actually continue to be attractive enough, a $3 discount, given that Russian crude, can actually ramp up to at least 25-30% of your overall sourcing mix, that can actually add as much as 90 cents, for lack of a better term, to the GRMs, which is definitely a significant number, whichever way you look at it. Now, whether India's political policy allows these imports to continue, I'm afraid, I'm not really qualified to comment on that. But at the moment, the official stated policy and the declarations by the companies is very clear. Wherever economics actually works, as far as crude sourcing is concerned, they are going to continue to, source crude from wherever they get it at the best price possible.
Completely. And I understand, of course, India is one of the world's fastest growing economies right now. It needs all of the energy that it can get. So there is a sense of justification inside India at this point. But at the same time as well, Probal, no doubt you've seen the criticism being leveled towards policymakers inside the country right now, including the Prime Minister himself. Peter Navarro penning what was a very interesting piece earlier this week, accusing India of being a global clearinghouse for Russian oil. He said India is also being opportunistic with these purchases of Russian crude. Is the geopolitical blowback really worth it? That's the question, though.
Again, I think you would probably need to talk to ministry officials and secretaries and people who are more well versed in the geopolitical aspects of it than I am. As I said, I think the decision that has been made and the declarations that have been made make it very clear that it's going to be economics and the availability and basically the legality of it, I think, is something that needs to be considered. Russian crude exports are not really banned. If you look at the EU sanction package that was announced before the tariff decision by President Trump, that also made it more difficult to basically purchase Russian crude. It made it more onerous in terms of pricing controls on Russian crude. In terms of, the price cap that was actually put was much more restrictive. But at no point of time, from what little I can understand, and you can correct me, it's not still illegal to basically purchase Russian crude at the end of the day. It is obviously more costly because with the additional sanctions in place, you were mentioning about some dark fleets being used and all. I don't want to comment on that, but what it does mean is that associated costs with respect to importing crude, whether it's freight, whether it's insurance, whether it's arranging for vessels in the first place, that anyways has become more difficult. Having said that, if you are still able to procure that crude at a cost which is still economic to you, given the kind of price caps that are in place, I think that is something that India, at least officially, and from what we understand from the companies, that is what they will continue to do. I think that is basically what is playing out at this point of time. Obviously, the US will have its own say, and there is a government-to-government level interaction that will probably determine a few things. But at this point of time, I think what we are seeing play out is that India is going to continue to probably import Russian crude, as long as it's actually available, even if it is at a slightly higher cost than before.
Probal, is it also your understanding that from a purely logistical and technical area, it is more difficult for India to swap out these Russian barrels and find qualified, suitable replacements?
Look at the numbers. I mean, globally, crude supply is at maybe about 101 million barrels a day. Spare capacity is notwithstanding, even with OPEC bringing some cargoes back on a gradual basis, bringing the entirety of the 2.2 million barrels that had been, cut earlier. Even then, it's not like there's 4.5 to 5 million barrels of oil floating around somewhere. So if you're talking about taking out the entirety of Russian crude from the global markets, obviously that crude will have to come from somewhere. It's not going to be easy for any market, whether it's China or India, to sort of replace those lost crudes. If India goes out and more aggressively tries to source crude from North America, South America, or Africa, or any other portion, there is some other geography that will lose out. So at the very least, taking out, let's say, this 1.6, 1.7 million barrels that India was importing from Russia, if you're going to be replacing that with other crudes, number one, in terms of crude quality and the crude assay, I don't think that there is a problem of compatibility if you're going to be replacing it with alternate crudes. But arranging it in a short period of time, obviously it's not as easy. I think it's going to cause a lot of logistical issues, and it's going to cause price spikes in the global crude scenario, with that kind of that amount of crude actually going off the global supply chain.
So talk to me about what you're seeing in the market right now. And on this question of the Russian alternative, how competitive are these Russian barrels against some of the Middle Eastern grades at current spreads?
I think that, as I said, I mean, if the $3 discount, if what we are hearing is true, at $1.50 discount, I would imagine that, every other player, given the volumes that India consumes, would probably offer some trade discounts to try and match up. We heard reports earlier that Iraq was offering crudes at near parity to Russia, or somewhere close to that, in terms of effective price to Indian buyers. So obviously at $1.50, that advantage is not significant. But once it crosses $3.50, that is not a discount that I think Middle East players are willing to sort of supply. So you would probably still have a clear $2.50 advantage, assuming that depending on the volumes, you will get a 50-60 cent trade discount here and there. Russian crude will still be at a clear advantage at this point of time.
And to what extent is the oil market actually pricing this right now? Are we seeing a physical impact on the market at the moment?
In terms of global oil markets?
That's right.
Yeah, I think $67 doesn't really reflect 4.5 or for around 5 million barrels, which is the Russian, export volume going off the market. I think very clearly the prices indicate that, whatever are the pushes and pulls of the global geopolitical, environment, those barrels will continue to flow in one form or the other. I think at $67, very clearly, if you had a supply shock coming, the prices would be much higher. And if I look at even futures prices, if you look at CME futures, for example, for the next 12 to 18 months, they seem to indicate a price of somewhere around $65 to $66. So again, it doesn't look like the market is pricing in these barrels completely going off the market. So if and when it happens, or if you start to see real disruptions, I think that can beg your pardon. I think that can cause a real pricing, spike for once that event is, sort of visible or more certain, as it were.
And just going back to something you said before, you said prices haven't necessarily spiked yet because we also see OPEC unwinding these 2 million barrels a day of cuts. If that buffer disappears, though, how exposed do you think India could be to a potential price shock here?
Look, the math is very simple. I mean, obviously, India imports about close to 75 to 80% of its crude requirements. So any spike in price is something that is significant. If you look at the overall imports, that's about, I think, 4.2 to 4.3 million barrels a day of imports that is there. So if you look at even every dollar increase in international crude prices, I mean, that's about something like 1.4 to 1.5 billion dollars on an annualized basis. So in that sense, it's a significant hit that can happen, and I think that is something that we remain vulnerable to, and which is where I think the counter argument comes, that to then expect that policymakers and the government would basically just stop buying Russian crude at this point of time, or basically just stop exports coming from Russia altogether. That seems very difficult to do, at least in a short period of time.
Talk to me about the general economic sentiment as well. Of course, India also being hit hard by Trump's tariffs. What's your expectation on how this could ultimately impact crude demand moving forward?
I think crude demand obviously always is a function of overall GDP growth. So, if GDP growth obviously gets hit, typically, if you look at historical fuel consumption growth, it has always been a proxy to a real GDP growth. Somewhere around zero point 0.6 to zero point 0.7 to 0.75x has been the delta in terms of GDP growth. If I assume GDP growth at 6.5%, fuel consumption growth typically clocks in at 4.5% or so. So any hit that happens to GDP growth rates because of whatever is happening on the tariff front and on the trade front, of course it will have an impact on fuel consumption. But having said that, I think what also sort of makes a difference is what is the mix in terms of fuel consumption. There is natural gas demand also that you've got to factor in, that can come in as an alternative if liquid fuel demand becomes prohibitive because of pricing issues or overall economic growth being limited, because natural gas availability and natural gas sourcing, I think, is something that is really improving quite a lot over the next 12 to 18 months. If you were to look at projections from IEA or the International Gas Union or any other industry body. So I think that will probably help offset the damage to a certain extent, even if prices go up. But again, I mean, these are all things that are very, very uncertain at this point. So I don't want to hazard a guess of what fuel consumption growth will be, or indeed what GDP growth is going to be. I'm not nearly qualified to do that, frankly.
It's a fair point. It's a fair point. But is it also your expectation that these tariff measures are going to stay in place, and also the pressure that we see from the US administration on India regarding these Russian oil purchases will stay intact as well? Do you see any prospect of any kind of relief on the horizon?
I don't want to get into trouble, Dan. I wouldn't want to comment on the possibility or the probability of either of that. I track the energy sector. I'm not really a geopolitical analyst or a strategy guy. So, I would like to refrain from commenting on the probability either ways of what's going to happen on that front.
Okay, Prabal. So before we wrap it up, also give me your take on where you see general crude prices tracking in the second half of this year as well. We spoke about OPEC's increased output plans. Of course, the group has been adding barrels back into this market. We see the geopolitical risk premium still intact as well, of course, not just off the back of developments here in the Middle East, but also globally as well, given the Trump trade and tariff agenda. Is it your expectations that we'll see oil staying in this range towards year end, or could we see movement in either direction, up or down at this point?
I think there's two aspects to it, if I can take a minute. One is that, if you look at the OPEC's decision to sort of replace these barrels, what has also happened, however, is that actual production on the ground has actually lagged the stated declaration of how many barrels they're putting back on the market. That's something that's not new. Production tends to vary quite a bit versus their quotas up and down. So one will have to really see how much of additional supply actually gets brought back onto the market. That's number one. Secondly, as we were discussing throughout, what really happens to the Russian flows, how much of physical flows are actually prevented from coming onto the market, whether by lack of interest or via sanctions. That's something that's one more factor. And third, of course, is overall demand growth, which has obviously been a little bit of a worry in the first place, because if you look at the demand growth estimates again by the IEA, that's pointing to a fairly slow growth trajectory for at least CY25 for crude, whereas projections by OPEC, and you can argue that both of these bodies have their own, priorities in terms of what story narrative to push. But that projection is at about, I think, 1.2, 1.3 million barrels a day. So somewhere between that, if you assume that about a million barrels a day of growth is still there in the next 12 months, and Russian supply doesn't really go off the market, I think supply continues to fairly remain, comfortable, if one were to say that. And therefore, crude can remain in the range of maybe from where it is here to about $73, $74. We'd think that futures prices probably are a bit more pessimistic. They tend to obviously be more near term in terms of their outlook. And therefore, we do see a little bit of an improvement in the second half. But, as long as the barrels keep flowing, we don't really see any huge upside triggers from these levels.
Okay, Prabal, we'll leave it there. Really appreciate the conversation. Thank you so much for coming on today. That's Prabal Sen, Senior Research Analyst at ICICI Securities. Up next on the program, we're going to discuss how Indonesia's high-speed rail project is bleeding money and the lessons India can take away from it. Stay tuned. We're back in 2 minutes. Welcome back. Indonesia is aiming to expand its high-speed rail project, but is it feasible? Let's get straight up to JP Young joining us live now from Singapore on this. JP, walk us through it. What do we know?
Yeah, Dan, that is the $7.3 billion question with Indonesia trying to expand its high-speed rail from Jakarta to Surabaya. But before they do that, they might want to make sure it is feasibly in order and feasibly sound. This is a warning, actually, that was raised by the president-director, actually, of Kereta Api Indonesia, which is one of the local investors in the high-speed rail that connects Jakarta to Bandung currently, when he spoke to a parliament in front of Parliament via a hearing, where he said that that they have to restructure the finances of this high-speed rail because it is starting to resemble what he called a time bomb. Now, that's very strong words, but you have to remember that this high-speed rail itself, apparently in the first half of this year, has already lost $100 million and continues to bleed money despite the promise of connecting cities across the island of Java at a faster clip. Now, what's also important to note is how this project was financed. The initial tranche, which connects Jakarta to Bandung, was financed via a consortium of Chinese and Indonesian investors that hold a 60-40 stake actually in the high-speed rail. But this was also financed 75% by a loan extended by the China Development Bank at an interest rate of about 2%. So you're facing a lot of debt burdens actually on a high-speed rail that some analysts say might only break even in 40 years. And also, as it continues to lose money, there is a question as to whether or not they will be able to actually look for more financing to extend it all the way to Surabaya on the other side of Java, and whether or not other investors such as the China Development Bank or other Chinese consortiums might decide to pony up money to try and finance this expansion. Because if it is losing money now, there is a question as to whether or not they have to get things in order first and make sure it breaks even before they even think about extending it ambitiously another 500 kilometers to the other side of Java. So a lot of big questions actually, but again, it just shows you that managing and running a high-speed rail, especially in developing countries like Indonesia, might be more complicated, more difficult than it seems, Dan.
So, JP, let's talk about the lessons learned. India also building its own high-speed rail corridor. What lessons can India take from this whoosh experience?
Yeah, and the whoosh experience, as you've aptly coined it, Dan, really does pose a few things that India might want to keep in mind, because by late 2027, the first phase of the high-speed rail that will connect Mumbai to Ahmedabad might be coming online. These are some of the stations in the state of Gujarat, and by 2028, they expect it to connect these two large cities in India via a high-speed rail. The high-speed rail that connects Jakarta to Bandung is about 142 kilometers. This one in India will span over 500 kilometers. So you can imagine that it's at a bigger scale. And because the economic profiles of India and Indonesia are fairly similar, there will be questions as to whether or not India can run this in an efficient and in a feasible break-even way. Now, what's also important to note is the difference in how these projects were financed. In India's case, it's actually financed by JICA of Japan, and which has extended about $13 billion to finance this particular high-speed rail. But what's also important to note is they're actually financing it at a longer term and also at a much lower interest rate, actually, of about 0.1% as compared to the China Development Bank loan to Indonesia of 2%. So there are questions as to which is the proper financing mechanism for infrastructure projects of this size, because while the benefits of making connectivity faster in countries like Indonesia are there, actually, there are questions as to how you're going to finance that. And if they are struggling to break even in Indonesia, that is something that India will also have to ask itself, whether or not they can actually operate this in an efficient manner, in a break-even manner, to make sure that if they want to extend it later on, they can actually do that. Because again, it doesn't help anybody if you're running a high-speed rail that isn't making money, or at least not financing itself, Dan.
It's a fair point. And JP, also, any thoughts on project timelines here? Exactly how long is this going to take to eventually be completed?
Well, okay, so the first things we've gotten, at least with regards to the Indian case, Dan, is that some of the first stations in the state of Gujarat might be coming online, at least based on their timeline or their goals, by late 2027, meaning the stations around Ahmedabad will be coming online first before the ones in Mumbai. And they want to complete the full completion, that 508-kilometer completion across those 12 stations by late 2028. So these are the milestones we want to look out for. 2 years from now, we'll start to see the first stations around Gujarat actually coming online, and by 2028, the full connection from Mumbai to Ahmedabad coming on, which will see travel between the two cities cut to just over 2 hours. But as we've seen, These are timelines. These are goals. Usually there are some project delays that actually come up because there are questions of bureaucracy as well and whether India can actually meet these timelines effectively. A lot to be asked, but 2027 perhaps is the first milestone to look out for, Dan.
JP, really appreciate the update. Thanks again for joining us today. That's JP Ong there. Up next on the program, we're going to discuss India's REIT market. The CEO of Knowledge Realty Trust joining us live next after its market debut earlier this week. Stay with us. Welcome back to the program. We are counting down to the market open in India. Here's how things are shaping up as it stands. Of course, relatively muted start expected when trading gets back underway in India off the back of what has been a mostly volatile with mixed session in Asia more broadly. But you can see Nifty futures are pointing into positive territory there. Multiple new listings in the markets this week as well. One of them, Knowledge Realty Trust, making its debut at a 3% premium to its IPO price. And it has been on an uptrend since. The offer drew strong demand, subscribed more than 12 times. The REIT is backed by Blackstone and Indian realty firm Sattva Group. Well, Shirish Godbole is the CEO of Knowledge Realty Trust. He joins us live now in Mumbai for a pulse check on the sector and perhaps the decision to take this REIT public. Shirish, welcome to the program. Great to have you on today. First, just your reaction to the debut that we've seen. This was over sub 12x, but only a 3% pop on debut. Are you satisfied with the performance so far?
Thank you. Thank you, Dan, for having us and having me on the show. Yes, we sort of listed at a 3% pop, but we're now at about 107, which is about a 7% pop. And I think given the volatility in the markets, and I think ultimately it is a REIT product, we're quite satisfied. And, clearly the demand we had at the time of listing, and we priced the transaction with almost a 13 times oversubscription, suggests that the story that we have has been well accepted. And I feel like the market will, receive us better as we move along and spread the story and execute our plans.
Sri, certainly a really interesting space for investors right now. And what we see in India right now is multiple listed office REITs. So take me inside this decision, the strategic decision to go public now. Why was this the right moment?
Yeah. So, Dan, this is the fifth REIT now in India. And we really had been planning this for a while. So, when you have a 46 million square foot REIT, with 29 massive properties, you have to obviously plan for it. This has been in the works for a while, so we had been working on it. And the life cycle of the assets was such that this was the right time to sort of put them into a public format, right? A listed format. So while we had been working for a while, and that's how we're here, it wasn't like it was specifically only now that we were going to try and do this. We also had very good office sort of tailwinds behind us. We felt that the office markets were in a good spot today, and we expect that trend to continue going forward. So when you add that all together, it seemed like the right time to go to the market. I will add that the volatility in the markets is such that a REIT product sort of is accepted well in today's market, which provides a steady yield and appreciation over it. So it's a very good, stable product to have in the context of the volatile markets we're in.
So, Sharice, take me inside the numbers. Where do occupancy levels stand today, and where are you putting the outlook in the next 3 to 6 months?
So we, at the time of listing, were at a 91% occupancy in our portfolio. We project that very shortly to move on a little bit higher, and then over the next 3 or 4 years, we are projecting it to go up to a 96% occupancy. The markets really are robust. There is a lot of support and demand, and so we feel comfortable that we can achieve this kind of occupancy, and it's for two reasons, right? There is a front office or a city-centric portfolio within our overall portfolio, and so as the India story continues to move along, and Indian firms, and therefore consulting firms, legal firms, etc., also expand, there's a lot of demand for our front office space. And as you may have heard, there is a significant amount of demand for global capability centers, which is the big story behind Indian office. And that story continues to be very positive, and those trends will also help our office demand. And so when you combine the two, we feel we're well positioned for this growth.
Expand on that for me, because Ramesh Nair of Mindspace REIT was also on the show earlier on in the month, talking about how a lot of the occupancy demand that they're seeing is also being driven by this GCC space. So talk to me about your own occupancy goals within that GCC arena and how you're going to compete.
Yeah. So, fortunately, there is a lot of demand, right? So I think from a competitive standpoint, if you have good product, which is what we have, well located, which is what we have, I don't foresee competition to necessarily be an issue. I think the trend we're seeing is because, technology today is really part of the business, right? I mean, I think they almost sort of work together, and global capability centers, therefore, are a very important part of businesses worldwide. And I mean, it's not just North America, but also Europe and even Asia Pacific. And businesses have to work with technology, and therefore having that technology as part of your business and really working with you is an important asset. And we are seeing that across the board. We currently have, as I think Ramesh or others may have mentioned, we have about 1,800 global capability centers in India. They, hire and retain about 2.5 million people. We expect that job profile to go from 2.5 million to 4 million over the next 5 years, and actually, the global capability center count to go up from 1,800 to 2,500. So it's a very strong trend, and we expect it to continue, and that's why we're okay with our occupancy projections.
Let's talk about growth plans as well. Are there any specific regions or cities where you see the best opportunity for growth, and what is the strategy to scale further from here?
So we are definitely going to scale up. I mean, one of the points I would like to emphasize is we are a brand agnostic platform. You know, Knowledge Realty Trust is intentionally brand agnostic. We want to try and attract, especially non-strategic or smaller developers who may have a 1, 2, 3 million square foot portfolio to become part of our REIT, keep their local branding, become part of our REIT. And that is the proposition we're going to go out with to all the big markets in India, right? So the demand is really primarily today, at least in the larger markets, the, Mumbai, Hyderabad, Bangalore, NCR, Chennai, Pune, those are the kind of markets that we would primarily look to, and that's where we're going to look to expand. The right opportunity is what will drive us. So if it's accretive and it makes sense, we're going to make the acquisition. We're not here just to make an acquisition for the sake of it. We're obviously going to try and be disciplined and look for that opportunity. So that's what's going to drive the location.
And are you talking about acquiring already operating office properties or developing greenfield here?
So, primarily the focus is on either already built, where there might be an asset management opportunity to move up the rents or, reposition the asset. But there could also be situations where assets are half built, or there could be a position where there's sort of two towers within, a complex where you have an existing tower that's built out, but there's land attached that can be developed out. So there's multiple ways to go about it. We have 8 million square feet of developable land in our portfolio already. So we're not going to go out just looking for totally ground up developments right now. We're going to try and focus on the land we have and then look for these kind of acquisitions where we can add value. That's where we are.
Shirish, there's so much opportunity out there in this space, but of course a number of headwinds as well, and you can rattle them off. The rupee, of course, really sensitive to oil prices at the moment. At the same time, US interest rates really in flux. Capital flows also in question off the back of the Trump trade and tariff agenda as well. How exposed would you say your foreign investors are to currency risk right now for their returns at the moment? And what kind of returns can unit holders realistically expect in the first year in this environment?
Yeah. So, just stepping back, right? Global currents are such that you can't completely fight them. The dollar is strong, and it is and will be. I think the flows of money will kind of be what they will be. Hard to sort of control that for us. What we can do is just look at the competitiveness we offer, right? And I think, in sort of a different way to look at it, a cheaper, rupee, a stronger dollar makes the rents in India actually more affordable. And if you may recall, Indian rents have been lower and sort of pegged to $1, if you want to call it. And of course, they've now gone up beyond $1, frankly. But a lot of the global capability centers actually look at a dollar rent, and that's kind of a sort of a saying around India. And so to a certain extent, I'm not totally disappointed because the 88 rupee or 90 rupee, if that's where the rupee ends up, makes that space that much cheaper from a global capability center standpoint, right? And that makes us more competitive globally. And that's one of the big reasons why we're seeing this GCC trend, is because it is attractively priced. And combined with the skill set that India offers, the GCCs will remain always an opportunity, right? And I mentioned the growth in technology. So when you put the growth in technology, the availability of talent, and the price points at which these are available, and you put them together, yes, there might be some headwinds and some currents, but I think this is a secular trend that's going to play out over a long period of time. We're not worried about the GCC demand in an extended period of time. In a short run, there might be some ups and downs. But that's the way, economies play out. In terms of returns, we have a 7.2% stabilized yield that we offer to our investors. We expect capital appreciation on top of that. And so together, we're looking at about a 15% return combined, or mid-teens, I would say, plus or minus.
15%, double digits, pretty strong. Shirish, we'll have to hold you to account on that. Just quickly, what would you say is the biggest single risk that you face right now as a listed REIT in India?
So honestly, Dan, I think it's what you highlighted, right? The geopolitics of the world is such that it is hard to predict the flows, and there might be some ebbs as we look at it. But if you step back from our portfolio standpoint, we have a very, very good portfolio. It's well located, and in real estate, location obviously is always key. So we have strong assets, well located, with, at least for now, strong tailwinds in the office, not only in the GCC space, but also in that front office space, right? And if Indian economy continues to do well, that demand will definitely continue to be there for us. So when you combine that, from our perspective, we're very confident and comfortable of the future and look forward to acquiring assets and growing this REIT very quickly.
Shirish, it's such an interesting space. I hope you'll come back soon. Appreciate the conversation. Thanks for coming on today. Shirish Godbole there.
Thanks for having us again,
Realty
Dan. Thank
Trust.
you very much.
And on the macro front, we also got infrastructure output numbers yesterday. Output in July up 2% from a year ago, just a touch lower than the pace we saw in June. The big push coming from steel and cement, both posting double-digit growth. On the flip side, though, coal took the biggest hit, down over 12%, with oil, gas and refinery products also slipping. And staying with the infrastructure theme, Ultratech Cement has announced plans to sell up to 6.5% of its stake in its unit India Cements, valued at nearly $86 million. Ultratech, which took control of India Cements in July last year, is required to cut its holdings to comply with Indian regulators, which cap promoter holdings at 75%. Ultratech currently owns 81.5% of a stake in India Cements. And Indian miner Vedanta is facing objections from the National Company Law Tribunal over its proposed demerger, with officials warning the move could hinder the recovery of dues, according to CNBC TV18. During the proceedings, officials alleged Vedanta altered its demerger scheme after receiving clearance from SEBI. The report also cited government claims of concealment and non-disclosure of key information. Vedanta said it has responded to those allegations. And we are counting down to the market open in Mumbai. Stay with us here on Inside India. We're back in 2 minutes. back to the program. Straight to the wall for your India opening calls here. Indian markets just coming online. It is a positive trade. The open on the Nifty 50 showing an upside of around 0.2% here, holding on to that 25,000 handle. The rupee at 86.95 against the greenback as it stands. Banking tycoon Uday Kotak, the founder of one of India's biggest private sector banks, Kotak Mahindra, sounding the alarm on US tariffs. In an interview with the Financial Times, Kotak asked the government to provide direct fiscal support to protect small and medium enterprises from possible tariff shocks. He joins a chorus of tycoons now really calling on New Delhi to do more to withstand the impact of Trump's tariffs. Meanwhile, as Kotak sounds the alarm on the economy, a panel of state ministers met to discuss the goods and services tax reforms promised by Prime Minister Modi. The overhaul is expected to give a boost to consumption. The panel proposed exempting tax on health and life insurance premiums. You can read more about this in this week's Inside India newsletter on our website. Just scan the QR code to become a subscriber and get it in your inbox, hot and fresh off the press. Okay, let's talk about what's happening in these markets. Rana Gupta is here. He's the Managing Director of Indian Equities at Manulife Investment Management. Rana, welcome to the program. Great to have you on today. First of all, we are seeing a positive start to the Thursday session on the Nifty 50, but I wanted to pick up on a conversation that I've just had with the CEO of Knowledge Realty Trust, coming on to talk about this debut that the REIT made earlier on in the week. We saw a pop in the REIT off the back of what was a 12x oversubscribed IPO. Really interesting space in India. Curious to get your take on this REIT, though. Is this something that clients are asking about, or at least in this space right now?
Hi, Dan. Glad to be here with you. We do not comment on specific stocks, but we would say that Indian IPO market has been very lively, and the IPOs are getting very good responses. And the REIT, to an asset class extent, is concerned, it is now gaining additional popularity in India because they can offer a certain amount of yield, which I think is quite attractive in an Indian context. So I think IPO and REIT, that's a good place to be in. But unfortunately, I won't be able to comment on stock-specific names.
Well, I appreciate the reaction, but let's talk about what's happening in these markets as well. Reuters reporting today that foreign investors have sold a net $13 billion worth of Indian stocks this year, including around $2.4 billion in the first half of August alone. Rana, what's your take on general market sentiment and direction right now? What do you think has foreign investors so spooked?
Sure. I think this selling and the market action has to put in the context. The context is that post-COVID, for last 3 to 5 years, India has been one of the top performing market because the earnings were growing very fast. Now, because the earning exceptionalism that India had, that seems to be waning off a bit. And as a result, what we are seeing is that market has been consolidating for last 1 year. As the market consolidates, I think some of the FIIs are also finding better opportunity in their view, maybe in other Asian markets. What is also, I think, contributing that India putting highest in the tariff order among the Asian countries. That could also drive some sentiment. But the way we see it, I think this market can consider for some more amount of time. The earnings are settling at over 11-12% as opposed to earlier cliff of 15-16%. This needs to get priced in and get into people's understanding. Having said that, I think the valuation is in line with average, and the domestic participation of investors continues. So that's a positive. So therefore, I think to make money from this market, one has to be very much focused on the sector and the stock-specific levels.
Indeed, and the Sensex still trading at around 23 times forward earnings. That is among the world's highest. Rana, there is a general sense right now, including on Wall Street, that valuations are starting to look stretched and that perhaps some kind of correction is coming. What's your take on valuations in India right now, particularly on the Sensex? Is it a cause for concern?
The valuation is in line with what we have seen post-COVID. On a longer time frame, it looks slightly on the higher side. But let me give you again the context that why the valuation is relatively higher as compared to other markets. India is one of the markets where the domestic savings cannot go out of the country. So the domestic, and for the domestic savers, equities, the risk adjusted and the tax adjusted basis also is one of the most attractive investments. So therefore, there is a lot of systemic investment plans which are getting into equities, and also you're seeing good participation in the IPO markets. So this domestic flow which is coming into the equity markets are sustaining the higher valuation for the equities, because at the end of the day, this demand is estimated to be about $4 to $5 billion a year. So we're looking at $60-70 billion plus annually. That's a large demand. And that's what has led to valuation a bit higher side than as compared to before. Previously, we did not have domestic participation at this scale. That's what the market's reflecting.
Rana, could I get your reaction to what we're seeing happening on the tariff front as well? A lot of anxiety over tariffs and global trade right now. That's also being reflected in the C-suite in India as well. What did you make of these comments from Uday Kotak, founder of one of India's biggest private sector banks, talking about how perhaps the government needs to step in directly here, provide direct fiscal support to protect SMEs, to protect against some of these shocks? What do you think? Good idea?
Yes, but first let me comment on the tariff part of it. When the base tariff also, that 25% we're talking about, it came as a bit of a surprise, given the India-US relationship that has developed over the past decade or so. We were expecting the Indian tariff to be in line with other ASEAN or ASEAN countries. To that extent, 25% is a negative surprise. Although we hope and we think that over a period of time, negotiation will be done and the tariffs will be set back to the average Asian or ASEAN levels. But just in case it stays at 25%, then it's a headwind. And that headwind can be mitigated by fiscal transfers. And if you take a step back and look at it, some of it's already started. In fact, on 15th August, the GST rate cut announcement came post this tariff announcement. Previously, as per our understanding, the plan was to realign the GST duties, but not really cut it. Now the idea is to cut it to boost the consumption market. The interview that you were referring to, support to small and medium enterprises, I think if it happens, will be very welcome. And there are precedences of it. In the past cycles, when the small, medium enterprise asset quality gets more challenging, we have often seen the government come up with some credit guarantee schemes, and that has helped a lot. What I want to highlight is that the government's fiscal position is strong, the macro balance sheet is strong, so therefore, should the government want, they could go for something like that. And that is a big cushion for the India to offset the tariff-related issues if they were to happen.
Okay, so if that is the case, what is your highest conviction trade if we are coming into what could be the GST cut in October, but also at the same time the Trump tariff deadline as soon as next Wednesday?
Right. So we look for sectors and stocks, and that, where there are certain tailwinds, and there are companies with agile management who can take advantage of it. So let's start the GST rate cut. I think the GST rate cut can boost domestic consumption, and it's very beneficial for domestic auto companies, which we like. Then moving on, with or without GST, I think the companies or sectors which are gaining market share, they are doing irrespective of all of this. And I would say consumer tech companies, travel companies, here the markets are expanding, so they're not so dependent on the macro to deliver good numbers. Then moving on, I think in the financial space, the large private banks, they're doing well on their own because the economy in nominal terms is growing and they're growing along with that. And they're profitable, so growing on the same equity, delivering value for the shareholders over the longer term. Additionally, we also like the infrastructure space because for infra space, for certain telecom companies, hospital companies, power companies, or real estate companies, the main phase of capex is getting over. So going forward, cash flows will be significantly higher. So we participate in that. On the industrial side, we are a bit more circumspect. That said, that's one area in the industrial that we do like. That is India's push to have more domestic manufacturing. And the domestic manufacturing push in the areas of electronics are very credible. A lot of incentives are given to companies who set up shop there. And I think there are domestic companies who are taking advantage in electronics manufacturing, white goods manufacturing, and also backward integrating to components. That's also one area, EMS, electronic manufacturing services, that we like.
Okay, Rana, I wish we had more time, but we'll have to leave it there. Thanks so much for the conversation today. Appreciate you joining.
Thank you.
That's Rana Gupta there from Manulife Investment Management. And that's all we have time for today on this edition of Inside India. Keep watching CNBC. Stay with us. Access Middle East is coming up next.